Yes, we can. Yeah, I appreciate that. Thanks for staying on. Thank you. Bye. Hi everyone. I'll just be kicking off the the webinar in 1 second. I just want to ensure, can everyone hear me okay and see me okay? Oh wait. Can everyone see me okay and hear me okay? I just want to double check the audio and the sound before I begin the update. If anyone could just please just type it in the chat box there saying, hello, is the sound and the audio okay? If everyone could just respond, that would be great, because I look to kick things off as soon as I get confirmation that both, yes, we can, brilliant. Once we get confirmation that everything is going ahead in terms of loud and clear, brilliant. I'll just start off now with the risk warning slides as I do. I've just, in a moment's time, you should see the FX Paysa logo and the risk warning stating that trading in margin products carries a high level of risk. I just want to ensure that everyone can actually see those risk warnings before I look to actually go ahead, and it should be popping up now. So excellent, there you go. Before I actually begin the webinar, I just need to point out basic introduction. My name is Dave Madden. I work as a market analyst at Equity Capital in London. Equity Capital is one of the many companies within the overall equity group, which of course includes Equity Nigeria and also FX Paysa. And as just to clarify, this webinar should not be does not contain any investment advice, any trading ideas. Anything that I said in this webinar is purely just my own thoughts, views, and opinions. So I'll look to get things going now. So before we actually get into the details of what's going on with the non-farm payrolls, let's just take a quick recap of what's going on with the US markets in general. We saw a sharp move to the upside here in the S&P 500 recently. On Wednesday, just gone, we had the minutes from the most recent Fed Reserve meeting, and they made it. And although they were hawkish, they weren't as hawkish as they weren't any more hawkish than the update in June, where the Fed hiked interest rates by 75 basis points. The Fed also said they expect the US economy to rebound in the second quarter of this year. So what we've witnessed since Wednesday night in the US has been a broad rally in stock markets around the world. We've seen a rebound in metals. We've seen a bit of a rebound in energy as well. So overall, there's a bit of a kind of a risk-on attitude taking place. If you look here at the price action of the S&P 500, just to let you know, I'm looking at a 4-hour chart here. We can and the 3 moving averages that I have on screen are a 20-period moving average, a 50-period moving average, and a 100-period moving average. Look at the price action here. We can see it's been moving higher here the last few days. We recently hit its highest level in over a week. We're above all 3 simple moving averages. Looking at the RSI, the relative strength index, was essentially kind of a measure of almost like kind of elasticity, kind of how much the market's moving in terms of kind of it's almost like the kind of like the rate of change. That's moving higher. We can see, and because it's moving higher, a rise in the RSI, suggests the price bias is to the upside. That's moving higher. We can see here on the MACD indicator, the moving average convergence divergence. We can see here that although positive momentum has faded a little, momentum is still firmly, excuse me, in positive territory, which indicates that the bulls are in control. So while the S&P 500 continues to hold above these 3 simple moving averages, it seems that it's likely the short-term upward trend in the US 500 will continue. If it do rally from here, where could we go? Well, I'll be looking up towards 39.46, and a break beyond that could see us up towards 40.24. If we do see a move to the downside in the US 500, where could we target? Well, I'll be looking back down towards this moving average here, the 50-period moving average. We can see, if you follow this line around here, you can see on several occasions it acted as resistance here, it acted as support here, it acted as resistance here, it acted as support here. What I always do is look at price action in the past and try and use that as a gauge, as a kind of educated guess for what might happen in the future. What I often say is, if a metric has been of importance in the past, it makes it more likely to be of importance in the future, although there are no guarantees. So if we do drift lower in the S&P 500, where can we target? Well, that moving average comes into play around 38.36, and a break below that could see it down toward this moving average here around 37.96. And if you have a large sell-off, I'd only really begin to kind of hold a bearish view on the US 500 if we were to break below this zone here, the lows here of early July in around 34.72. Sorry, apologies, 37.40 rather. Now, this is the US jobs report. The traders will be focused on this update and ask themselves the question. The Federal Reserve hiked interest rates by 75 basis points last month. They gave off a very strong indication there's going to be another large interest rate hike in the US this month. Will it be a 50 basis point hike? Will it be a 75 basis point hike? Will it even be a 100 basis point hike? So essentially a rate hike in some shape or form is basically a done deal. It's now a question of how large a rate hike is to be expected. So when this jobs report comes out, people are going to be asking themselves which one of those kind of 3 options were a 50 basis point hike, a 75, or a 100, and that's what it's about. Both when we've seen bouts of selling in the last few weeks, such as here, the US 500 back in mid-June fell to its lowest level in over a year and a half. That was driven by the fact that was the night the Fed hiked interest rates by 75 basis points. That was the kind of fallout from the 75 basis point hike and the impression we're going to have another large hike in July. Since then, we have seen a bit of a rebound. The rebound ran out of steam. About a week ago or 10 days ago, we kind of concerns, perhaps the US economy is heading to a recession. So it's no longer the interest rate story kind of dropped off the radar a bit, and the recession story came back to the fore. And of course, if there's a recession likely on the horizon, will the Federal Reserve keep hiking interest rates so aggressively, or will they even look to cut rates later next year or perhaps in 2024? So we've seen a bit of a rebound in market sentiment. So ultimately, what I'm getting at is when we look at this jobs report, we're asking ourselves the question: what's the next rate hike going to be from the Fed? If it's a 50 basis point hike, we possibly see a continuation of this upward trend. If it's a 75 basis point hike, we might see a bit of a pullback, perhaps even a pullback before the longer term uptrend continues. And if you see if you see a very blistering, strong jobs report, and traders get the idea that the Fed will have a 100 basis point hike, a 1% lift, I think that's the point at which we could see a fairly large sell-off. So taking a look in case of what to kind of expect this year is trading economics. This is the economic calendar that I'm using. Looking here at the headline number, we're expecting a reading of we're expecting the unemployment rate in the US is 3.6%. We're expecting it to hold steady at 3.6. And whereas on the headline unemployment on the headline non-farm payrolls report, we're expecting a reading of 268,000, which would be a fairly large drop off compared with the last report of 390,000. Excuse me, I have a bit of a cold. Which would be a fairly large drop off compared to the previous update of 390,000. Also, what's worth a while keeping an eye out for is average earnings. The previous average earnings reading was 5.2%. We're now expecting it to dip to 5%. Average earnings is a good way to find out what's going on with the employment market, because in the last year and a half or so, employers have been finding it difficult to get people into certain jobs, particularly in travel, tourism, hospitality. And as a way of coaxing people into a job or to switch companies or to come over or to take on this job, they've had to offer higher wages. So if you see wages rising, that's probably a sign that workers would rather say, no, I'm not working. I'm only working if I were to get this particular pay package. So my experience, we got 3 minutes on the clock before the numbers come out. In my experience, people are too fixated on the headline number. They're too fixated on the 268. Is it better or is it lower? And then they react off that. The update needs to be taken as a whole. Essentially, we have 4 pieces of information coming out. Some are more important than others. We have the headline reading 268. Do we beat that or are we below that? Keep an eye on the 390, the last month number. That might be revised higher or lower. Also keep an eye on the unemployment rate. It's been holding around 3.6 for a while now. Is it going to go higher or lower? And then lastly, to a lesser extent, keep an eye on the earnings component. So the entire update needs to be taken as a whole, and then as a whole assess it. Each component: headline, revision, unemployment, earnings. 4 of those are all kind of fit into the entire mix. The first 2 are the most important. The latter 2 are the least important, but still they're influential nonetheless. What's also been going on in the markets has been a very, very strong US dollar. This year is euro dollar. It fell to yet another kind of 20-year low this morning, which really kind of speaks volumes about A, how strong the US dollar is, and B, how weak the euro is. There's talk that the Eurozone could be edging towards a recession. There's talk that Germany, the largest economy in the Eurozone, could be edging towards a recession. And for the reasons I've laid out, the US labour market's in a strong position. And on top of that, we've already had a few large rate hikes from the Federal Reserve with the view to having a few more. That's been driving up the US dollar. So this month, the European Central Bank has made it clear they'll do a 25 basis point hike. They might do a large hike in September, but that's obviously is some time away. Whereas the Fed, as I mentioned a minute ago, they're looking likely to have a large rate hike this month. But the question is, how large will it be? 50 basis points, 75 or 100? And today's jobs report is going to influence that decision. So you got less than a minute on the clock now. So it all depends how it comes in. If the report comes in thereabouts in line with expectations, I can't imagine volatility being increasing too much. It's only really if the number is much stronger and much worse than expected, would I actually expect to see any sort of update. So you can look here at the numbers. The number came in at 372,000, well above expectations of 268. The previous update was ever so slightly revised lower to 384. That's neither here nor there because it's only nudged down from 390. I would suggest overall it's a pretty good update from what I've seen at the headline numbers. Just to refresh this. So just to recap, we came in over 100,000 jobs more were added than expected. That's quite a decent beat in terms of expectations. Unemployment rate 3.6%, and then we also saw a slight revision lower from 390,000 down to 384,000. A slight revision lower, almost negligible revision lower. I would suggest that looks fairly good. On the unemployment rate things, on the hourly rather, wages came in at 5.1%, better than expected 5%, whereas the previous wage figure of 5.2 was revised up to 5.3. So wages are still doing fairly well. We had a very impressive beat on the headline number, and there was essentially unemployment remained unchanged in line with expectations. And lastly, there was a tiny and almost inconsequential revision to the last month's number. So I would suggest overall this is a good jobs report, and I would suggest the US dollar will get stronger. Will probably get stronger on the back of this. And if you do see any weakness in the S&P 500 and US stocks, I wouldn't be surprised if it's only a short-term weakness, because this kind of just, we're still not any clearer whether the Fed is going to have a 75 basis point hike or a 50 basis point hike. A 50 seems like an absolute done deal by now, but will we have a 75 basis point hike? That remains to be seen. So looking here at the on a very short-term basis, this is a 1 minute chart, aggressive move to the downside in the euro. Obviously, this is a strong dollar story, so no real kind of surprises there. I'll switch back now to a 4 hour chart here. So the euro itself, euro dollar continues to be in the strong downward trend. We're holding below all three of these simple moving averages. If you look at the RSI, even though it's off its recent lows, it's still in oversold territory. So I would suggest between the price being close to its 20-year low, we're below all three moving averages. I suspect the kind of the longer term, medium term downtrend is going to continue. Moving lower from here, I'll be looking down to parity, 1.0000, and a break below that could see it down towards 99.0, spot 9900, and then 98 would be the next level to watch out for. If we can manage to stage a rally in euro dollar, where could we go? Well, if you follow this 20-period moving average around, you can see it acted very nicely as resistance here, kind of actually almost as support here, a resistance zone there. So euro dollar itself, the 20-period moving average rather, has a bit of a track record of acting as resistance. So it's possible it could act as resistance again in the future. That metric comes into play at 1.0213. Keep an eye for that level should you see a rally from here or a snapback. If you rally beyond that, next big level to watch out for on euro dollar will be this last high here, just where the market turned lower in at 1.0325. So watching out for this area here. Feel free to ask me any questions about the update. Feel free to say, would you mind explaining that again, or else what do you make of this chart, and then just happily kind of type in a chart that you want me to take a look at. So I suspected that this is a strong story for the dollar. We've seen it move to the downside in the euro dollar already. I took a quick look at the S&P 500. I wouldn't be surprised if, because it's a good number, people got a bit nervous initially, and we saw a bit of a move to the downside in the US 500. But I still think overall, the medium-term uptrend for the US 500 will continue. So I take a look at a 1 minute chart just to see how things are fared. There you go. like I guessed, we did see a fairly sharp move to the downside in the US 500 immediately after the number came out, because the headline number was quite strong. But keep in mind, there's no great surprises with average earnings or else the unemployment rate. And lastly, there was a tiny revision to the last month's number. So it was a good update, but it probably wasn't as good as the headline number suggests. And that's why I wouldn't be surprised if we do see a continuation of the wider uptrend. Because like I said, at the very beginning of this update, people often get too fixated on the headline number, and then they base all the trading strategy around the headline number. And then after the dust settles and they look at unemployment, they look at the revision, they look at earnings and go, okay, the headline number was great, was much better than expected, but everything else was a bit in line. So overall, it's a good report, but perhaps not as strong as initially thought. So I suspect the kind of more medium-term upward trend is going to continue. It was a good enough report to suggest the US economy is on track and it can handle and sustain further rate hikes. It wasn't so good that the Federal Reserve have to kind of really consider another 75 basis point hike, or maybe look to hike by 100 basis points. Now, during the kind of pandemic, and up until only a few months ago, up until 6 or 7 months ago, the focus of the Fed was to get the unemployment rate down, which they've successfully done. Now they're very much fixated on inflation, and that's the real kind of their target at the moment. So until we see inflation starting to level off, I think further rate hikes are going to be on the agenda. I just got a question here. Got a question here about Fibonacci. The very basic idea of Fibonacci's fits in with the idea of Dow theory, where essentially there are trends within trends. And it basically talks about how if you have a long trend, say for example, moves to the downside, then there's a corresponding trend in the opposite direction, and a medium term, upward trend, and then a short term downtrend again. So and then essentially what it talks about, there are always kind of trends within trends. So for example, I'll give you the basic outline of this. This is going to work out big picture stuff. So the overarching trend of this to the downside, look at this. We can see a lower low, a lower high, a lower low, a lower high. You can see a series of lower lows and lower highs. The obvious kind of clear price pattern over the last few months, 6-7 months on the US 500 is to the downside, clearly in a downtrend. But you can see here, so the very long-term trend is low. This is far from a perfect trend line, but I just want to give you a vague idea. This is a vague idea. Number one, you have the massive downward trend, but every now and again you get large reverse rebounds. So the very long-term trend is lower. That is filled with lots and lots of small, medium-term counter trends, whereby the market has a rally. It gives up it gains, it rallies again, it gives up it gains, it rallies again, it moves lower, it rallies again. So we have a medium-term trend. And to really narrow it down, we also have a short-term trend. So we have a short-term upward trend here. If you look at an hourly chart, if you look at a 4-hour chart here, we still have the more medium-term downtrend. And if we have a long-term trend here, we also have a long-term downward trend. So it's essentially there are trends within trends, and Fibonacci essentially takes that view that you'll always have an overarching trend in a certain direction. And that every time you have a significant move in a certain direction, you'll always have a counter trend before the overall big picture trend continues. And Dow theory will talk about how whenever you have a certain long-term trend, say for example a market moves from 100 to 200, it rallied 100 points. Dow theory will talk about how every time a market has a pullback or a counter trend, most of those pullbacks will be between 35% and 65% of the preceding move. So if a market rallies 100 points, Dow theory will suggest most likely the pullback will be back 35 points, back 65 points, because the market previously gained 100 points. And Fibonacci is in the same structure, but Fibonacci at certain kind of key price points. So if you click on the F here, this will apply the Fibonacci. I'll do that on a different chart because a chart as clear. So if we were to look at, if we were to kind of measure the downward move in the Fibonacci here, what I'm doing is I'm essentially measuring, I'm taking this one move here, I've applied the Fibonacci retracement, idea to this particular downtrend here. So starting at this point here, this peak here, down to this low here. So I'm essentially measuring one downward move. And as I said with Dow theory, there are trends within trends within trends. So if you have one long downward move when the market falls from this zone here up around 1.07 down towards 1.03, the market has dropped above 400 pips. When the market has a rebound, it's probably going to put the size of the rebound will probably be a percentage of the preceding downward move. So Fibonacci has certain kind of key points within the kind of retracement idea. The market's moved lower here. It's dropped over 400 points. The very key different kind of metrics are kind of Fibonacci retracement levels: 23.6, the 38.2, 50, half, and 61.8. If we take a look at the price action here and measure from this peak here to this trough here and apply the Fibonacci retracement, we can see the market moves aggressively lower here. But you can see how it didn't quite perfectly stop at 50, but it got pretty much bang on 50 here. And if you look at this peak here, it basically encountered resistance once again at the 61.8% retracement before moving lower, and the overall downtrend continues. I just wanted to give you the basic idea of what it is: trends within trends. And after you have a certain move, the Fibonacci retracement, has identified certain percentage retracement points: 23.6, 38.2, 50, and 61.8. That's something for yourself to kind of play around with. And then essentially what you do is you look at certain retracement levels tend to be more prominent, and it's essentially kind of a trial and error and get a practice. And once again, as I said before, with a moving average, if a metric has been of importance in the past, it makes it more likely to be of importance in the future. So people will then apply the Fibonacci to kind of price action in the last day, week, month, whatever. And then they might look at it and say, well, more often than not, it reverts back to the 68.1 retracement before turning lower, and then you can use that as a position, as a potential area to either close out a long position if you're buying the dip, or could you use that as an opportunity to sell the rally if you're looking to go short again. Are there any questions? Any other questions you wanted to take a look at? Does the political landscape in the UK affect the GBP? Yes, it does. I take a look at the at pound dollar. We've had a strong US jobs report, which is strong for the US dollar, but of course it does. The weakness that we saw here in GBPUSD a few days ago, that was about 48 hours ago, when there are a lot of concerns that the British Prime Minister Boris Johnson might resign. So it's a kind of a classic example of buy the rumor, sell the fact, or in this case, sell the rumor and buy the fact. Whereby people were looking at the political uncertainty in the UK, and we saw a sharp move lower in the British pound. Part of this move is down to the strength of the US dollar, but by and large, is to do with weakness in the British pound. So that's moved aggressively lower in this regard here. Then once we actually had the confirmation that the UK Prime Minister, Mr. Johnson, announced his intention to resign yesterday, then we saw a bit of a rebound, because people thought, oh, we now know what's going on. We now know what's going to happen. At least he will leave at some point. The next bit of uncertainty is who's going to take over. What's their plan for the economy going to be like? So that's precisely why we saw a bit of a relief rally, only to turn lower again. And in fact, this morning, we've dropped to a new kind of 27, 28 month low on pound dollar. So pound dollar continues to be in a fairly clear downward trend. We've fallen to a new 27 month low this morning. The MACD indicator shows that momentum is in negative territory. The RSI is at the lower end of the range. It's moving lower as well, indicating the price bias is to the downside. If we do continue to move lower from here, to be honest with you, I'll be looking down towards some of the lows that were, if you continue to have a very large sell-off, I'll be looking down towards the lows that were set at the very beginning of the pandemic in around 117 down towards 116, 1660. And the really big level to watch out for will be the spring 2020 low of 1470. Now, if we do see a bit of a rally in pound dollar, where do we target? Well, if you look at the price action here, we've been moving aggressively lower, but on several occasions, we've seen a bounce back. As the old adage is, markets don't move in straight lines. So even though we're in a downward trend, the market moves lower here, it rebounds, it encounters resistance at the 20-period moving average, and moves aggressively lower again. It has a fairly large rally. Although it breaks above the 20-period moving average, notice how this peak here didn't retest or break above this peak here. The market moved aggressively lower, creating a new 27-month low. The market's had a rally. It's broken above the 20-period moving average. It didn't even actually retest the 50-period moving average, and now it's moving lower yet again. And in the last few minutes, we've seen quite a strong US non-farm payrolls report. So traders are probably going to ask themselves, if this downward move continues, we could probably retest the recent lows. And if we break below that, that'll be a fairly good indication that the kind of broader bearish trend is going to continue. To be honest with you, it's only really if we break above this metric here, the 100-period moving average. If you look at the 100-period moving average, you can see it acted very nicely as resistance here in late June. And once again, if a metric has been important in the past, it makes it more likely to be of importance in the future. And that 100-period moving average comes into play in around 120 will be the next big level to watch out for. Beyond that, I'm looking up towards 2166. I'm just conscious of the time now. I've been speaking for about half an hour. Anybody else have any questions? Any markets you want me to take a look at? Also, when we had the US numbers come out, we also had the Canadian numbers come out. So we can't overlook our friends in Canada. The unemployment rate dropped to 4.9% from 5.1%, so that's decent. Also, it actually declined, so it actually came in better than expected. Oil, sure, US oil or UK oil. Looking at the gold, looking at the unemployment change, it dropped by over 43,000, whereas economists were expecting an increase of over 23,000. That's worse than expected. Looking at the full-time figures, full-time unemployment dropped only by 4,000. So it seems to me it is more in the part-time space. There's a much larger decline. Crude oil, Brent crude oil, UK oil. So taking a look here now, I'll cover Brent crude oil and I'll cover gold, and then I'll look to wrap things up. So take a look at the price action here of UK oil. As you can see, if you just look at the big picture trend here, once again, looking at a 4-hour chart, the big picture trend is to the downside. Broadly speaking, a series of lower lows and lower highs. The level we fell to on Wednesday was a kind of 6-7 week low. So we're printing multi-week lows, which to my mind kind of tells you everything you need to know about the state of play. Things are looking a little on the bearish side. What's going on in the overall fundamental news? Well, although today we had a decent jobs report in the US, there are still concerns that the US economy might be edging towards a recession. Those concerns are even more so when it comes to major economies in Europe, such as the UK and Germany. So there's an overall kind of, the headline stories in the news tend to be global economy is cooling. Some countries could be live for a recession. With that, if global economies go down a gear, you'd imagine that demand for the energy such as oil would decline. Hence why we're seeing multi-week lows being printed in UK oil. So, even though we've had a decent rebound, we're still holding well below these two simple moving averages. And as far as I'm concerned, while we continue to hold below these two simple moving averages, I expect that the longer term downward trend will continue. Moving lower from here, I think we could be looking at heading back down towards moving lower back from here, I think we could be heading back down towards the recent lows of 97.13. And then if we go below that, we could then be looking heading down towards 95.32. So watch out for 97.13 and 95.32. Looking at the price action the past 24 hours or so, we've had a fairly sharp rally here. Momentum has swung from negative territory to positive territory. The RSI is moving sharply higher as well. It's no longer in oversold territory. If we do see the short-term gain extend and rally, where can we target? Well, I'll be looking towards this moving average here at 109.65. Looking at the price action here, we can see it's encountered resistance here from this peak here, at this peak here, and also this peak here. It didn't act perfectly as resistance, to be fair. It is worth pointing out the market, crept slightly above the moving average before turning lower on 2 occasions. So keep an eye for that area there. That comes into play around 109.65 up towards 110. And then if you have a decent break above this moving average here, I'll then be looking up toward this peak here in 115.88. Lastly, now coming on to gold before I let's wrap this up. The gold has been in a very aggressive downward trend recently. It's been moving sharply lower. The lows of the last few hours haven't actually retested yesterday's low, but yesterday we fell to a new 9-month low. So it really says a lot about how bearish gold is when it's falling to a 9-month low. We're at a 9-month low. Momentum is firmly in negative territory. The RSI has moved lower. In fact, it's moved into oversold territory. So that in itself could be an indication that the kind of broader, we could be in for a bit of a snapback. Looking at the kind of big picture for gold, I think we could be heading back towards 1721. This area here, 1721. And if we break below that, I'll then be looking down towards 1700. As I mentioned, the RSI, that could be a bit of a flash warning. RSI is in oversold territory. This could be the kind of warning sign to say that the move to the downside is overcooked. And if you do see a bit of a snapback, where can we target? Well, I'll be looking up towards, first and foremost, these peaks here in around 1750 thereabouts. And then the next really big level to watch out for will be these 3 peaks here in around 1772. So watch out for 1750 and 1772 to the upside for gold. If you break above 1772, the next big level to watch out for beyond that will be 1800. Just before I'm conscious I've been speaking for about 40 minutes or so. Before I look to wrap things up, I'll just remind you, for those of you who are on Twitter, I'm fairly active on Twitter. My Twitter handle is @dmadden_equity, @DMADDEN_EQUITI. Feel free to get in contact with me on Twitter. Ask me questions, what do you make of gold? What do you make of crude oil? Whatever it might be. Like with the webinar, I can't or won't give any advice or any kind of explicit trading ideas. But what I can do is I will happily kind of take a screenshot of a chart, and like I've been doing in today's webinar, just talking about this is what's going on with the prevailing trend. If the prevailing trend continues, we could hit these prices over here, A and B, And if you see reversal in the price action, we could target these zones here, X and Y. I'll look to wrap things up there because it's coming up to we're approaching the hour, so I'll look to finishing things there. I do want to thank you all very much for tuning in. Particularly those of you who ask questions. It's always a bit more fun for me whenever I ever have a bit of interaction, and especially get some questions that I wasn't necessarily expecting. It's also nice to have a bit of a chat. Otherwise, it's not as fun when you're just basically kind of talking to a webcam and there's no one else to reply back. So I just want to thank you for that, and I look to wrap things up. So just put there in the chat box saying thanks, and everyone have a good weekend. And of course, I'll be around for next month's non-farm payroll as well. And also what you see me kind of talk about on Twitter as well, every single Thursday at 8 p.m. Kenya time, 6 p.m. Nigeria time, I also have my own webinar, Scan the Markets with David Madden. So feel free to sign up to the weekly ones, and I'll be around for next non-farm payroll this time next month. So end the stream now. Everyone have a good day. See ya.